In a world full of uncertainty, General Dynamics offers something rare: stability with a side of growth. From submarines to cybersecurity, this defense titan isn't just riding tailwinds, it's powering them. That's why my name is Varun Bazaz.
And my name is Kadam, and we're investors with Langley High School. Now, we're recommending that you buy to hold General Dynamics stock. With a current price of around 270 US dollars, we have estimated a target price of 371 US dollars, representing approximately a 37% upside.
Now let's go over some brief company information. General Dynamics is an American aerospace and defense company founded in 1952 in Virginia. It is one of the biggest aerospace and defense contractors in the world and operates in four main spheres. First is aerospace, where they manufacture Gulfstream business jets and U.S. fighter planes. Secondly is marine and maritime systems, where they manufacture submarines, surface ships, and recently Virginia-class submarines. Thirdly, they manufacture combat systems with land and expeditionary combat vehicles, recently Abrams tanks. And moreover, as defense is increasing in cybersecurity, GD has adapted, making mission-critical IT and communication services.
Now, on to our investment thesis. Why should you all actually invest in GD stock? Well, the first reason is because of the new administration in the US government. Now, President Trump has recently implemented tariffs that have introduced a lot of volatility and uncertainty in the defense sector, as investors are currently evaluating whether to capitalize on market corrections or take a more defensive stance. And this recent action has led to a slight dip in GD stock. However, this dip is only temporary, and we predict in the coming near future that this stock will go up exponentially. The first reason for that is because President Trump has issued an executive order aiming at facilitating international arms sales, which has the potential to open new markets and revenue streams for companies in the aerospace and defense industry, namely General Dynamics. The second reason is because the Trump administration has also made recent efforts to ease restrictions on U.S. military equipment exports, which is poised to benefit major defense firms, specifically General Dynamics. So, because of this recent action, we suggest that you buy General Dynamics stock right now while it's low, and then hold it while it increases in the future. And the next part of our investment thesis is favorable defense spending outlooks. Given that defense has always been a major priority for the US government, and that's not changing anytime soon, it makes most sense to invest in GD right now, while the demand will continue to rise following geopolitical conflicts all across the globe. And lastly, two added benefits of investing in GD stock are the high barriers to entry in the aerospace defense industry, which allows GD to exert pricing power over its competitors, and also GD's annual dividend yield of 2.19%, which they've increased consecutively for the last 25 years, allowing them to return consistent money to their shareholders via buybacks.
General Dynamics operates in two industries, aerospace and defense. Luckily, they're both rising. The aerospace industry has grown 18% in 2024, with a compound annual growth rate of 3.29%. The US accounts for 49% of this industry, and Boeing and Lockheed Martin, two peers of General Dynamics, have seen considerable growth over the past 5 years. In the defense industry, the US defense industry is estimated at $617 billion, and been an increase in global spending because of increased tensions in the past 5 years. Moreover, policy impacts the industry's valuation and trajectory, and as we mentioned before, President Trump's tariffs, executive actions, and policies are set to rise General Dynamics stock and defense contractor stock as a whole.
Now, in terms of General Dynamics' competitive positioning, we think that they have a competitive edge over their competitors. And the reason we think this is because of the proprietary technology. As General Dynamics closely guards its technical data, its technical designs, and most importantly, its manufacturing processes. Next is high barriers to entry. Now, as I mentioned earlier, the defense industry is very competitive, but it also deters new competitors from entering the industry because of its extremely high capital requirements and long certification processes. Lastly, the long-term contracts and procurement relationships that General Dynamics has with the U.S. government allows them to have a stable revenue stream because of the long-term relationships that they've established with the U.S. Navy and the U.S. Department of Defense, which allow them to have dependable partnerships with both their customers and their suppliers, and also deliver high-quality products and services to the U.S. government on a daily basis.
General Dynamics derives their revenue from multiple streams. The first and largest is defense contracts, as General Dynamics sells their proprietary technology to the US government to use for their defense. These are things like Virginia-class submarines and Abrams tanks, which the United States has contracts with General Dynamics, saying that they must buy them from that company. Moreover, as the United States and other countries have increasingly invested in cybersecurity, GD has followed. It has an IT services arm and provides communications and cloud computing to the US government. It also has cybersecurity services, which is an area of growing demand for government and military customers. Thus, you know that General Dynamics is adapting with the times. Moreover, General Dynamics sells internationally, as when it sells to the United States, they export their military equipment to other countries. And with President Trump easing restrictions for military exports, General Dynamics is set to get more revenue in the future, and thus its stock price is looking very optimistic. Moreover, General Dynamics maintains its relationship with its customers by maintaining, repairing, and overhauling the systems that they have already sold, leading to stable revenue.
Now, onto a quick financial breakdown of General Dynamics stock. So, in terms of profitability, General Dynamics overall has had great profitability metrics over the years, with operating margins consistently above 10% and a return on equity averaging around 20%. And this is because the company focuses on operational efficiency. And has a very diverse portfolio of businesses from aerospace, defense, and technology sectors, which have all contributed to its strong profitability. In terms of growth, GD has also managed to have steady growth over the past decade, with a CAGR of approximately 5%. And this growth has mainly been a result of a combination of organic initiatives, strategic assets, and constant innovation in both its product and service offerings. Now, with this high profitability and steady growth, GD also has very low operating costs. Because these costs are mainly just concentrated on the construction of aerospace and defense weapons. But this new innovation doesn't make a dent in a company as large and successful as General Dynamics.
We valued our company using a simple discounted cash flow model, identifying the most recent revenue, cash flow, and net income to project the free cash flow, terminal value, discount rates, and equity value for a time period of 7 years. To make this discounted cash flow method, we use key assumptions. First, we assumed a growth rate of 14.2% over the next 5 years, drawing on growth from the past 5 years and the relatively stable growth that GD has seen despite economic turbulence. We assumed a terminal growth rate of 3% because of General Dynamics CAGR of 3.55% and the profit growth of around 3% for the past decade. We assumed a discount rate of 10% by using the weighted average cost of capital. We find the WACC by first determining GD's capital structure by calculating the proportion of equity and debt in its total financing. Next, we compute the cost of equity using the capital asset pricing model, which accounts for a risk-free rate, the firm's beta, and the equity risk premium. Then we determine the after-tax cost of debt by dividing total interest expense by total debt and applying the tax shield. Finally, we derive the WACC by weighing the cost of equity and after-tax cost of debt based on their respective proportions in the firm's capital structure and summing the result. You can see that we got a WACC of around 9%. We wanted a more conservative valuation, so we made the discount rate 10%, leading to a share price of around $370. This a lot aligns with our pure PE valuation, where we use net income and total shares to get earnings per share, multiplying that by a pure PE average to get a target price of around the same found by the discounted cash flow.
Now, onto a few investment risks that General Dynamics faces and the way that they mitigate these risks. So, the first one is that GD is obviously dependent on US government contracts, so they get a significant portion of the revenue from the US government. Luckily for you all, General Dynamics has diverse revenue streams and has expanded in a variety of international markets with increasing demand, such as the Middle Eastern region and the Pacific Asian region. Now, another risk that General Dynamics faces is geopolitical and economic risks, given that they are a major defense contractor and any changes to international relations are bound to impact domestic and international markets. However, once again, lucky for you all, General Dynamics has a variety of financially sound initiatives to ensure operational efficiency in the company and control costs in the case of potential budget constraints. The last risk General Dynamics faces is competition when it comes to contract bidding because of the highly competitive nature of the aerospace and defense industry. And the way GD combats this is by investing in employee training and development programs to attract and retain the top talent in engineering, technical, and cybersecurity fields.
General Dynamics has made great strides in environmental, social, and governance, ranking in the 73rd percentile in a pool of more than 36,000. In the social sphere, General Dynamics invests in its workforce and supports communities with training. For the environmental considerations, General Dynamics minimized its carbon footprint and had a 25% reduction in emissions. For governance, it has a robust corporate and government framework and a strict code of business ethics that they follow.
Now, last but not least, the role of artificial intelligence. Now, we think that the capabilities of AI will only help General Dynamics become more successful and meet the needs of the US government because it has enabled greater autonomy in weapon systems, vehicles, drones, and unmanned platforms, as well as given a way into learning more about deep learning analytics and creating specialized machine learning algorithms.
Overall, whether it be through new policy implementations or long-term stable growth, General Dynamics isn't just a defense contractor. It's a long-term offense for your portfolio. Thank you.